Welcome back to Intermediate Accounting. In this video, we begin Chapter 17, Accounting for Investments. Chapter 17 covers the accounting for debt securities, equity securities, and other major issues related to investments in debt and equity securities. But in this video, we focus on accounting for investments in debt securities. We have looked at accounting for investments of debt when we looked at companies that are issuing bonds payable, and how sometimes those bond issuances can be at a discount or a premium. Now we're taking the perspective not of the borrower who's issuing the bonds payable, but as the buyer or the investor, the one who's giving up the cash in exchange for earning a return on interest revenue. The accounting rules for investments in debt securities, as well as for equity securities, depend on management's intent. In other words, management has to make a decision when they're buying the security, whether it's a debt or equity security. What do we plan to do with this? Are we buying this security so that we can sell it in the future? Or are we buying it, if it's a debt security, to hold for a long period of time, perhaps all the way until that debt security matures?
Yeah, these are my only intentions.
Let's take out our pen and pencils and some paper, and let's start taking some notes. Company purchases a debt investment or investment in debt securities, it's going to be valued on the balance sheet either at amortized cost or fair value. And the difference is based on management's intent. So if management, when management purchases the debt investment, if its intention is to hold that investment until that it fully matures, let's say a 20-year bond, hold on to that 20-year bond to get the semi-annual interest for the entire 20 years, then we would say that the management's intent, or management has no plans to sell, or in other words, intends to hold the security to maturity. If that's the case, then we might as well report it. Why don't we ignore those changes in fair values if they're irrelevant? We're going to collect the interest that we receive semi-annually until the bond matures. We're going to report it on the balance sheet at amortized cost. And amortized cost is very similar to the net carrying value. The net carrying value is, remember, the bonds payable plus any premium or minus any discount. And we call it the net carrying value when it's from the issuer or the borrower's perspective. And we call the valuation approach amortized cost, or the cost basis amortized cost, when it's from the buyer or the investor or the bondholder's perspective. Now, when the buyer purchases the investment in debt securities and plans to sell them, in other words, does not plan to hold to maturity, what's the alternative to holding to maturity? Selling at any point. And because those changes in fair values become much more relevant if they can be sold at any time, then we report those debt investments at their fair value on the balance sheet. Here we see a list of several of the more common types of debt investments: treasuries, munis, corporate bonds, convertible debt, commercial paper. And the accounting categories, the accounting rules for debt investments fall into one of three categories. Even though we looked at just two intentions here, no plans to sell or plans to sell, we're going to add one additional category here. So the first category is held to maturity. As you would expect, this is the category where management purchases the investment and plans to hold them until they mature. And sometimes we abbreviate this HTM. The second, as you might expect, is trading. Management purchases these debt investments, but they're willing to sell them at any point in order to capture a gain on the movement in the debt investment's price. What is that other third category? The third category is the other category, or management's not exactly sure category, and we call that available for sale. They're available if we want to sell them, but we may just end up holding them for a very long period of time, or perhaps until maturity. And we typically abbreviate this as AFS. Each one of these categories has its own accounting, and that's what we're going to cover here in this video. Let's look at these three categories in just a little bit more detail before we get into each category on its own. Held to maturity debt investments. Remember on the last slide or 2 slides ago, we said what is the valuation if there's no plans to sell? We call that amortized cost. We'll see in our examples in this video that that's going to look very similar to the net carrying value of a bond, but this time not from the issuer's perspective, but from the buyer's perspective. How do we account for unrealized holding gains and losses on held to maturity securities? Well, first of all, let's define again unrealized holding gains and losses. These are the changes in fair value over the period of securities that have not been sold. Values. Well, if the valuation of held to maturity securities is amortized cost, then unrealized holding or the changes in fair values, these unrealized holding gains and losses, are ignored or it's not recognized. What might be shown in income with a held to maturity debt investment? Well, of course, interest revenue. And that's typically going to be it. Sometimes these held to maturity securities, debt securities, are sold right before maturity, and then you might see a realized gain or loss going through. But let's just assume that they'll always be held exactly till their maturity date. How about trading securities? This is the other end of the spectrum. So when you think about the likelihood of sale of the debt investments, if there is a 0% likelihood of sale, these are definitely going to be held to maturity. And if there's 100% likelihood that we're going to sell probably within the next year, this would be considered a trading security. And the available for sale are somewhere in the middle, and it's up to management's judgment to determine exactly where do they want to draw that line between available for sale versus held to maturity or trading. Trading securities, because they can be traded or sold at any point, are going to be valued at fair value. That information is going to be very relevant to investors. And those unrealized holding gains and losses are going to go directly in income. And what might we see in the income statement? Well, of course, these unrealized holding gains and losses. Of course, interest revenue. And when these securities are sold, we're going to, of course, see realized gains and losses. Move to our available for sale securities. Because they could possibly be sold, there's a reasonable enough likelihood that they could be sold. We do give investors the information and report their valuation on the balance sheet at fair value. But to avoid earnings becoming very, very volatile on changes in fair values of these available for sale securities, we don't record the unrealized holding gains or losses directly in net income the way that we do for trading securities. Instead, we recognize these unrealized holding gains and losses in other comprehensive income. And remember, at the end of the accounting period, the balance in other comprehensive income for that period is transferred into stockholders' equity. A specific account within stockholders' equity is accumulated other comprehensive income, and we'll get to that in a little more detail when we're covering and looking at examples of available for sale securities. What other income effects? Well, we haven't seen any income effects so far. Well, of course, we would have interest revenue, so we can see here, regardless of the category, these are debt investments, so most debt investments offer interest revenue periodically over the life of the debt investment. So regardless of the category, we always see interest revenue here, and we will not record any unrealized holding gains and losses through net income. What else might hit net income? Realized gains and losses upon sale. Let's start by looking at the accounting treatment for held to maturity securities and walk through some examples. We classify a debt security as held to maturity only if the company has both the positive intent, or in other words, the intentions of holding that security until maturity, and the ability, meaning it's not going to run out of cash and need to sell these investments. Held to maturity securities are accounted for at not fair value. Do you remember what they are from 2 slides ago? They're accounted for at amortized cost. What we do is we amortize any premium or discount using the effective interest method, just like we did when we accounted for the issuance of bonds that are not issued at face value. Unless, just like with the bonds payable, unless the straight line method yields a similar result, so if the use of the straight line method does not result in a materially different amortization of the premium discount compared to the effective rate method, then GAAP allows the straight line method to be used. For the most part, companies are going to be using the effective interest rate method, so that's what we're going to focus on here. Income is only going to be affected by interest revenue and any sales above or below amortized cost. And again, this would really only be when it's very close to the maturity date. Let's take a look at an example here. Robinson Company purchased $10,000 of 8% bonds of Evermaster Corporation on January 1st, 2019 at a discount, so Robinson only paid $92,278. The bonds mature on January 1st, 2024, and the yield is 10%. For what we would refer to this 10% rate as, this would be considered the effective rate or the market rate. Interest is payable each July 1st and January 1st. These bonds have an 8% stated rate and a principal of $100,000. They are semi-annual bonds. So let's start. We're going to record the entry for the interest, but right now let's just record the investment, the fact that the company gave up cash and purchased a debt investment. So the company has an asset, debt investment, and I want to point out that when we see the word debt, it tends to make us think that it must be a liability. Really important to remember is that this is an asset account. Why? Well, it's an investment and held to earn a return. We can sell it and get cash for it. So this is an asset. And when the company gave up cash in order to purchase this investment, we record the investment at the cash paid in order to acquire it, $92,278. Then, as time goes by, we reach an interest payment date. Robinson Company records the receipt of the first semi-annual interest payment on July 1st, 2019 as follows. Now, this is going to be very similar to when we recorded the payment of interest when a company issued a bonds payable, but you're going to see a slight variation. So now this is the investor or the holder of the buyer of the bond, the holder of the bond. So they are actually receiving the cash at the first interest date. And how much cash are they going to get? The face value of the bonds, $100,000, times the stated interest rate on that bond, 8%. And it's a semi-annual, so 6 out of 12. So this is like 4% of 100,000 or 4,000. Now you're probably thinking that we are going to debit the discount. But remember, when we recorded the debt investment, we did not record any discount. So we're not going to record any amortization of a discount to a discount account. We are going to amortize that discount directly to the debt investments account. So we are increasing a debit to the debt investments asset account is going to increase the debt investments account. And we are going to solve this last because it's going to be the difference between the company's interest revenue and the cash received. You should see some similarities between this and when we recorded interest expense when the company was issuing the bonds payable. What is interest revenue? We're using the effective rate method. We take the beginning carrying value, or in this case, we're calling it the cost of the investment, $92,278. Multiply this by the effective or market rate of 10%, or the yield, Semi-annual, so times 6 out of 12. So 92 is 278 times essentially 5% gives us interest revenue of 4,614. The difference is recorded as an increase to the debt investments. Remember, from the investor's perspective, we start out at 92,278. That's what we're giving up, so that's what our investment is worth. But when we receive the principal at maturity, we're going to receive 100,000. So we're building our way up there. So at this point, what is the amortized cost of the debt investments? So what would we see that with the balance sheet report in debt investments in the asset section equal to the beginning balance of 92,278, and then we increased it by 614. We would report, if we put together a balance sheet on July 1st, 2019, we would report the debt investments at 92,892. We would call this amortized cost. Time goes on, it's the fiscal year end for Robinson Company, and we see here that the bond is going to be paying, the debt investment is going to be paying us, Robinson Company, interest January 1st, so tomorrow. So what we need now is not an entry for the cash receipt, but an entry for the interest revenue earned and the interest receivable we need to record at year ends. This is our adjusting entry. So we debit interest receivable instead of cash. We'll get the cash tomorrow. And how much? It's going to be that same 4,000. Face value of 100,000 or principal of 100,000 times the stated rate of 8% for half a year. We're going to record the reduction of the discount, which is going to increase our debt investment. We're going to determine that number last. And finally, we are accruing for the interest revenue, which is equal to the amortized cost after our last entry, 92,892, or we can look at this as the initial 92,278, add the 614, same as we said 92,892, multiply this by the market or effective rate or yield of 10%, and this gives us interest revenue of 4,645. That difference, of course, goes to increase our asset debt investments. So what is the amortized cost after this entry is recorded? What is the balance sheet going to report? We take the 92,892 that we see here, and we add the additional 645 that has just been recorded. And we get amortized cost on the December 31st balance sheet, 93,537. And this is what we would see on the balance sheet. We would have our interest receivable that we had just recorded. We're going to get that interest tomorrow. We have the debt investments at amortized cost, 93,537, and interest revenue that was recorded each of the two semi-annual periods. The income statement reports a total of 9,259 on the income statement. Now let's move on to our second category of debt investments, available for sale. Available for sale securities, remember management's intent, we're not exactly sure whether we're going to sell these in the near future or hold them to maturity. We can do either. Companies report these on the balance sheet at fair value, not amortized cost, and unrealized holding gains and losses are reported as other comprehensive income. Remember, other comprehensive income is a separate component of stockholders' equity. We'll cover that in a little more detail in just a few slides. Just like before, any discount or premium is amortized, but again, we do not use specific discount or premium accounts. Let's take a look at an example. Graph Corporation purchases 100,000 10% 5-year bonds on January 1st, 2019 with interest payable on July 1st, and from Graph's perspective, that's interest receivable, July 1st and January 1st. The bonds sell for $108,111, which results in a premium of $8,111 and an effective interest rate of 8%. Graph records the purchase of the bonds on January 1st, 2019 as follows. So what is Graph receiving? Graph is receiving debt investments. Again, this is an asset account. The cost incurred to acquire those debt investments. The company has to pay cash for these investments. The next entry that's going to take place is the interest revenue on July 1st. This is the very first interest receipt. And the company receives cash. This is an interest payment date. The face value of the debt investment is $100,000. The stated rate is 10% in this example, and these are semi-annual. So the company is going to receive $5,000 of cash. Because this was the debt investment was purchased at a premium, that premium is going to decrease over time. So we are going to credit not the premium account, but we're directly going to credit the account debt investments. The amount is going to be the difference between the cash and the interest revenue. So let's go ahead and solve for our interest revenue. This is equal to the acquisition cost and amortized cost at this point times the effective or market rate of 8% times 6 over 12. And that gives us interest revenue of $4,324. The difference between the cash that we receive and our interest revenue is our decrease to the asset debt investments of $676. What about on July 1st, 2019, the entry for interest revenue? Slide here obviously should say not July 1st, but December 31st. We just recorded the entry for July 1st. Now it is December 31st. We're about to put together our financial statements, and we need an adjusting entry to record the interest revenue. Debit the account interest revenue. We'll get the cash tomorrow. Again, $5,000 for the same reason as we calculated the cash receipt 6 months ago. Credit to reduce the debt investments account for the amortization of the premium. And record interest revenue. Because we're about to report our income statement and we need to show that we've actually earned how much. So we purchased the bonds or the debt investment at 108,111, and then we reduced that amount 6 months ago by 676. So let's subtract out 676, and let's multiply this by the market or effective rate of 8% and allocate it for half the year. And we will get interest revenue of $4,297. And the difference between our interest, sorry, this should not, as you know, should not say interest revenue. This should say interest receivable. We decreased debt investments by 703. Let's take a look at what else we need to record, because remember, so far all we've done is take our debt investments down to amortized cost, but available for sale debt investments are not reported at amortized cost. They're reported at fair value. So we need one more type of adjustment. Remember, companies report available for sale securities at fair value, and unrealized holding gains or losses are reported as other comprehensive income. We saw this slide before. Changes in fair values are recorded to the account fair value adjustment. The fair value adjustment account is what we call a valuation account. It's just used to track changes in fair values. When the balance sheet is prepared at the end of the year, that valuation account is going to be applied against the debt investments so that those debt investments will be recorded at fair value. But when you dig deeper, when you're actually in the accountant, when you're the accountant and you can look in the general ledger and you dig deeper into that debt investment accounts, you're accounting for those debt investments at amortized cost, and then you're separately tracking the fair value changes in this valuation account called fair value adjustment. I'm going to abbreviate this for now as FVA because I want to say how does this account work? A debit to the fair value adjustment account increases the value of an available for sale security. Because remember, debt investments account carry debit or assets, so they're increased with a debit, and the fair value adjustment account goes along with that debt investments account. So a debit to the fair value adjustment increases the available for sale securities, and a credit would obviously do the opposite. Credit to fair value adjustment accounts for a decrease or decreases available for sale securities. At the end of the period, the available for sale debt security is reported on the balance sheet net of the balance in the fair value adjustment account. This causes those debt investment accounts to be reported at fair value. Changes in fair values. So remember, we said one part of the entry is going to be either a debit or a credit to fair value adjustment. A debit if fair value is increased over amortized cost, a credit if we're decreasing it for what happened this period. What's the other side of this journal entry? The other side of the journal entry is to an account called unrealized holding gain or loss dash equity. And sometimes we abbreviate this, unrealized holding gain or loss equity. This account is reported as other comprehensive income. You might remember this from Intermediate 1 when we looked at the income statement very closely and we said that some unrealized holding gains and losses bypass the income statement and they go to this separate place called comprehensive income through the item other comprehensive income or OCI. Other comprehensive income affects the equity account. Remember the name of that stockholders equity account? Accumulated other comprehensive income. For now, we'll just write AOCI, accumulated other comprehensive income. All we really need to know is it goes to OCI and then it affects stockholders' equity. How do the accounting rules work? A debit to unrealized holding gains and losses dash equity. Well, if this is an equity account, what does a debit do to equity accounts? Does it increase or decrease equity? Decreases equity. And of course, a credit does the opposite. Anytime we credit a stockholder's equity account, it's going to increase stockholders' equity. Now, there's a lot here that we've gone through, so I have just a couple of slides to refresh some of these definitions. OCI, other comprehensive income. Remember, certain unrealized gains and losses bypass the income statement and are reported in the statement of comprehensive income. AOCI is accumulated other comprehensive income. Remember, at the end of the accounting period, the balance in OCI is transferred into the stockholders' equity account, AOCI. And of course, this is not to be confused with AOC, a member of the House of Representatives. Here's what a journal entry would look like if we want to decrease the fair value of an available for sale investment. We would debit unrealized holding gain or loss dash equity and credit fair value adjustment. Of course, if we wanted to increase the fair value of a debt investment, we would do the reverse, debit fair value adjustment and credit unrealized holding gain or loss dash equity. Now let's take a look at an actual example where we're going to book some journal entries. Remember our bonds from the example we had been working on for a graph company, the debt investments, where we had recorded the first interest payment and then our accrual of interest revenue at year end. It is year end and we now need to, because these are fair value these are available for sale securities, we need to record a fair value adjustment. Remember, we came up with the amount, the amortized cost would be 108, 111, 676, and then subtract out an additional 703. We see what that gives us here. That's going to give us an amortized cost on 12/31, and as we can see here on 1/1, an amortized cost of 106,732. The fair value, and you might be wondering why that's different, well, based on what market interest rates have done. This is simply amortized cost based on the market versus stated rates on the date that the debt investment was purchased. This is the fair value if that bond were to be sold out in the market today. It would on December 31st, 2019, it would be 105,000 because market interest rates have changed since the time of issuance and the time the balance sheet is being prepared. So the difference between the 105 fair value, remember available for sale securities, report them at fair value, and the carrying amount or amortized cost, 106,732. Ask yourself, is this an unrealized gain or an unrealized loss? So the book value or carrying amount is 106, but if we were to sell them today, we'd get 105. So that is going to be a loss, but it's not a loss that goes through income because that's the rule for available for sale securities. The loss goes through equity, and so we are going to debit the account unrealized holding gain and loss dash equity. This is going to decrease other comprehensive income, which will then decrease stockholders' equity. For the difference between 105,000 and 106,732, this difference is 1,732. And what account do I credit for the 1,732? I'm going to credit the account. I'm not going to go directly to the debt investments, but I'm going to use the valuation account that gets reported together with the debt investments. Fair value adjustment. Remember we said to increase fair value adjustment, we debit. Here we want to decrease, so we book a credit. Now, what if the company has not just one debt investment, but a portfolio of available for sale debt investments? So here we see this portfolio of not one, but two investments. And we see we're given here the amortized cost and the fair values. So companies are not making fair value adjustments off of every single security. It was just too time consuming. So what they do is they track the amortized cost on all of them, that fair values of all of them, and book one fair value adjustment for the entire portfolio. So we're given here, we're told that there's zero balance in the fair value adjustment account, but we need to take the fair value of our securities, our two debt investments, down 9,537 from amortized cost to fair value. So what would that journal entry look like? Let's record that journal entry here. Fair values decreased. That's a loss, but not a loss to net income. So this is going to be an unrealized holding gain and loss to stockholders' equity for this amount, 9,537. How do I know this is a loss? Because I see amortized cost. Take that down to the fair value. Fair value is actually lower by 9,537. And the other side of this is, of course, the fair value adjustment account. At the end of the period, the financial statement date, the balance sheet is going to report interest receivable for whatever amount has been accrued. The debt investments available for sale, remember, if they're available for sale, this is going to be amortized cost together with the amount of the fair value adjustment. In stockholders' equity, we're going to see the cumulative total in unrealized holding gains and losses for these available for sale securities. We'll see interest revenue for that interest that has been received or accrued on the debt investments. And if any debt investments has been sold during the period, we would see a gain or loss on sale of any available for sale debt investments. Now let's move on to our third and final category, trading securities. Companies report trading securities or debt investments classified as trading at fair value with unrealized holding gains and losses reported in net income. Why? How does this differ from available for sale? Available for sale, we may end up holding all the way till maturity. But these trading securities we have purchased with a specific intent to capture gains and to sell these anytime in the near future, uh, typically between about the next 3 months or perhaps the next year. But we're actively trading them, so we want to let investors know those unrealized holding gains and losses and not surprise them on the date that we're actually selling these investments. Again, any discount or premium is amortized. A holding gain or loss is just like the unrealized, except we're realizing it. Just like unrealized, it still is unrealized, but because we're going to actually realize it in the near future, we're putting those unrealized gains and losses into net income. Let's take a look at an example. Here is a company, Western Publishing, that has a portfolio of 3 debt investments. We see the amortized cost, we're given the fair value, and we have no beginning balance in the fair value adjustment account. So we can see that fair values are $3,750 higher than amortized cost. So this will lead to an unrealized gain that will flow right through net income. At December 31st, Western Publishing Company makes an adjusting entry. So we want to increase the fair value, so we're going to debit the account fair value adjustment. $3,750, and we're going to credit to increase unrealized holding gains and losses dash income or net income. So when we credit net income, we are increasing net income, which is exactly what we want to do. Let's take a look at one last example. Hendricks Corporation purchased trading investment bonds for $50,000 at par, no discount or premium. At December 31st, Hendricks received the annual interest of $2,000, and the fair value of the bonds at year-end was $47,400. Let's record the 3 entries that are necessary here. The purchase of the investment is part A. When the company Hendricks purchases the investment, they're going to debit debt investments at the acquisition cost, $50,000. In order to get those debt investments, the company had to pay $50,000 in cash. Next, on December 31st, the company receives the annual interest of $2,000. Now, notice here we're saying annual, not semi-annual, so our next entry is December 31st. We receive cash equal to the face value, or also called the par value of the bond of the debt investment, times, we don't actually know the interest rate, so we are just told what it is, 2,000. And this relates to interest revenue. The debt investment was issued at par, so there's no discount or premium to reduce here. And then the last entry, we need to record the fact that the fair value of the bonds decreased from $50,000 to $47,400. So that is a decrease in fair value, which means we need to report a loss to the account unrealized holding gains and losses. This is not dash equity because these are trading securities. This is going to be to income. And we are going to decrease the account fair value adjustment. The amount of our entry is the change in the fair value. 600. And that concludes our last example. Here you see a summary of the accounting treatment for the 3 different categories of debt securities. We can see that the income effects are all fairly similar, except trading we have unrealized holding gains and losses recorded in income. Trading securities reported at fair value, available for sale securities also at fair value. Held to maturity securities not at fair value, but instead at amortized cost. Interest on a held to maturity is the only thing we're going to see in income. Available for sale, we're going to see interest as the only thing in income because the unrealized holding gains and losses are reported in other comprehensive income and stockholders' equity. Income effects of trading securities, interest revenue, of course, and unrealized holding gains or losses are going to go straight through income.